Hello and welcome to today's video. It's always good to have many assets that bring you money from different angles. The problem is managing it. When to buy, when to sell, how much more to put in, which asset is best for now, which is not good as of now, where to put in my money, where not to put in my money. A big headache. But in spite of all these headaches, in spite of all these problems, in spite of this big headache, it's still advisable to put your money into different baskets, into different investment avenues, to have a good mix of investment types in your portfolio. The reason is different investment types or different investment assets, they behave differently in a particular market scenario, in a particular market situation. Just to give you a hint, you might have seen that it's a general trend that when the stock market goes down, the gold prices, they go up, and vice versa. So why do we diversify? The reason is very, very simple, because it gives a highest possible return while reducing the risks by a huge margin. That's the only reason to diversify, to invest in diversified assets. In today's video, we'll see how diversification works and what are the different asset classes that you can put your money in and diversify your portfolio to reduce your risk and maximize your profits. So like this video right away so that this video reaches a lot of people and all your friends, relatives, and everyone else can benefit from this. So let's get started. A diversified portfolio has assets that has little or no correlation between amongst each other. When one goes down, the other goes up. And the combined effect of these two can actually save your investment. But more than that, the risk is greatly reduced because it's very unlikely that a particular event will wipe off your entire portfolio. Thus, diversification can be the best friend against the financial crisis. It's the best friend during the financial crisis. So let's try and understand the different assets and how they behave under different scenarios, under different situations. The stock market. Companies grow because there is an opportunity in this country, because there is an opportunity. The opportunity phase is now. There is business, there is economic growth happening. Currently in India, today, this is the opportunity. This is the phase when this country is growing. Yes, there are challenges. Yes, there are downturns. Yes, there are market dips. But as a whole, India is on your mark, get set and ready to go. You will get to know, you hear news about companies coming in, different manufacturing units shifting from other countries to India. Road and infrastructure developments are at its peak. Just as I said, we are about to just get set and go. But is it just a mockery? Should you capitalize on this opportunity? I would. You know best what you would do. Bonds, fixed income instruments. It helps to hold on to the capital when there is an economic downturn, when there is a pandemic hit, when there is something which is not going right. It saves your corpus. The pandemic, the war, the economic downturn, the market crash, market crisis, whatever you call it, doesn't matter. When that happens, investors, they run wild to hold on to assets that can save your money, that can save your wealth, that can save your corpus that you've built all your life. Although I understand for a bond, the issue price is fixed, but it can be traded in the secondary market. I understand it's available as per the demand. The interest yield may or may not be that attractive, but that at least it'll save your money. It'll save your money from being wiped off. Commodities. The price of these assets, they rise and they fall as per the supply and demand. They are not dependent on the economy. They are not dependent on external factors. They are only dependent on supply and demand. Oil, gold, wheat, anything, anything. The price of any of these commodities that you can think of, they only go up and down based on the demand in the market. If the demand is high, the supply is less, the price is going to go up. If the demand is low, the supply is high, the price is going to go down. You will notice that these commodities, they do not fluctuate based on the economic factors in the country. They do not follow the business phase or the business phase cycles just as closely as the stocks do. Funds, mutual funds, index funds, ETFs. See, you can use these if you are hardly hard pressed on time. If you don't have time to manage the market, if you don't have time to individually scrutinize and analyze stocks, you can utilize these investment options to diversify your portfolio. Crypto, it's a digital currency. It has a huge potential in the future, but I don't know. Currently, as of now, I see it's very, very risky. Metaverse, a concept of a persistent 3D universe, online 3D universe that helps you combine different virtual spaces, and it helps you, allow you to work. It helps you, allow you to work, meet, socialize, and do a lot of things. You can buy a piece of land in a metaverse. You can buy a piece of property in a metaverse. You can rent it out. That's your investment. NFTs, they're simply a token on a blockchain that represents a unique asset, which can be anything unique to you, unique art, a quote, a line, or a poem, a book, or whatever it is, or real estate, or whatever it is. Absolutely anything. It's a way of providing authenticity to a creator's work. Creating and selling an NFT can bring a ton of money for you. But there are some high-paid NFTs. Any idea how far an NFT can go before it gets sold? I'll read out an article. It says, every day, the first 5,000 days, it's sold for $69.3 million. Clock sold for $52.7 million as on today, as of now. Human One sold for $28.9 million. That's how big, that's how massive these NFTs can be sold for if they are in demand. Startups, very, very risky investments. A report from the Mint in May 2021 says that 90% of the startup, they fail in their first 5 years of their launch. It's very, very risky. 90% they don't survive. But for the remaining 10 who does, they can be amazing. They are amazing wealth generators. But you need to understand those points. You need to understand what makes a startup a failure or a success. A startup can run out of funds. They enter the market in the wrong time, at the wrong time, with the wrong product, bad partnership, bad marketing, no good experience or knowledge in the field, etc., and so on and so forth. There are tons and tons of reasons why a startup cannot be successful, or why a startup doesn't always become successful. To invest in a startup, you need to understand a company's goal. Are they in line with their goal? Does the goal that they have, is the goal in line with the customer requirement? Do the people in the startup, they enjoy the work they're doing? How will they react when a tough scenario or a tough situation comes in? Look so far how the company has performed. It's not available in the market, so you just cannot download it. So ask for it. Ask for the balance statement. Ask for the annual report. Read through it. Understand what's in it. Understand what went wrong, what's right, what's wrong, and then invest in the startup. You just don't invest in a startup just because you think it's in the early phase and it'll boom. It might or it might not. Real estates. You can invest in a property, apartment, a piece of land, and rent it out. That can be it. That can be a form of investment, a form of recurring income coming your way. But it requires a large sum of money, a big ticket investment. It's not possible for everybody to put in that huge sum of money. Alternatively, you can choose to invest in REITs, REITs. It's again a real estate investment trust. They invest in different real estates across the country, commercial properties, and those properties are rented out. 80-90% of those properties are not vacant. They are rented out. They already have a contract. The properties are complete. It's not an under construction property. So these are the government norms that are put on REITs, so that you lose very minimum if you invest in REITs. Unlike other high big ticket purchase in actual real estate, where the chances of loss is massive. See, in our opinion, I'll give you a mix and match of your portfolio which you can follow. This is what I follow personally, we follow, and we have benefited from it. This is not a suggestion, this is not a recommendation of any kind. You can choose and tweak as per your choice, as per your risk appetite, but this is what I personally follow. This is the breakup. 40% in stocks, bonds, in stocks, mutual funds, international stocks, Indian stocks, mutual funds, index funds, whatever it is, into the stock market. 40%. Be it in India, be it outside India, anywhere. Be it direct, indirect, through funds, whatever it is. 40% of my money, 45% approximately goes into the stock market. 20% into fixed income instruments like bonds, government bonds, AAA rated corporate bonds, and so on and so forth. This is just to capitalize on the market downturns. Why do I do this? I have this 20% money to invest when the stock market is down. I understand I do not earn a lot of money from this when the market goes well, because it gives a stable, secure income. I do sell off these bonds and buy in the stock market when the stock market bottoms out. The remaining 40% we put in different other investment avenues like real estate, REITs, venture capital, derivatives, commodities, and so on and so forth. Though every investment is an asset, except for the house where you're living in. But if you Google, if you find out the definition of your net worth, it says total assets minus your total liabilities. Here, they take the total asset, they take your house into consideration in your total assets. So according to the formula of net worth, it says your total asset, which includes your house, minus your total liabilities, is the kind of loans or whatever, any other liability that you have. So the difference of this is your actual net worth. That's as per the definition. But what we recommend is set the house aside and then calculate. So keep your house aside. That's not a liability. That's not an asset. Your house is not an asset. So when you calculate your net worth, when I calculate my net worth, which is different from the traditional definition, I define it as total assets, which does not include my house, minus total liabilities. Though every investment is an asset except for the house where you're living in, which is a liability. So this is how you calculate your net worth. It says, as per the definition, it says total assets minus total liability is your net worth, is what exactly you have. So as per the definition, when you count your net worth, you actually count your assets, your house into your asset, and then subtract your liabilities, which is your home loan and any other liabilities, into the liability column. So in your asset column, you bring in everything that you have purchased, minus in your liability column, which gives you the list of all the liabilities that you have, including your home loan. But I would recommend you to keep your house aside and then calculate the rest. Am I going against the normal definition of a net worth? Yes, I am. But here we are not here to learn the definition. I am here to give you a picture which is more close to your reality. So keep your home aside and then calculate the rest. What is it? How much have you invested minus any liability you have, which also includes your home loan. This definition will actually tell you how much you actually have and how well your investments are diversified. So as per our definition, net worth is your total asset excluding your home minus your total liability, which is including your home loan. This will cringe you. This formula will cringe you. It will devalue your overall belongings, but it's more towards the truth. That's all for today. Hope it has given you some idea about your investments and your diversification and how you can diversify. See you again in our next video. Till then, SC signing off. Goodbye.